Hey guys, welcome back to Trading Technicals. In this tutorial we're going to be discussing the Relative Strength Index, another popular technical indicator used in trading. We're going to be discussing it in terms of what is the RSI, how to set the RSI up, how to use the RSI moving average, and what buy and sell divergence is on the RSI. Okay, so let's get started. What is the Relative Strength Index? To start off, I'm going to show you this. And if you've been watching previous videos, you should recognize this as the stochastic indicator, which indicates a share price momentum. Now, this is the Relative Strength Index. You might see a similarity between the two and how they look, as that is incorrect, as they both measure share price momentum. However, they just go about this in different ways. The stochastic is a measure of the placement of a current share price within a trading range, and the RSI tracks the share price momentum, overbought and oversold levels, by measuring the velocity of price movements. So now that we've established what the RSI is, in terms of it also being a momentum indicator, let's get to the more important part on how to use this relative strength index to profit from your trades. Okay, so let's begin by looking at the basic relative strength. Alright, so in the bottom here, I've placed a relative strength index. It's a 14-day relative strength index, but we'll get to different settings later. Okay, so like the stochastic, it's bound between 0 and 100. Okay, and like the stochastic, it has a buy and a sell zone. However, the RSI buy zone is at 30 and below, and the RSI sell zone is at 70 and above, while the stochastic is at 80 and 20. But the principle works the same. So on screen, this is the basic relative strength index without a moving average. Now, you can see as the relative strength index hits above the 70 point, it's in the overbought region, and you can see the share price between these 2 points was at a high and came down afterwards. Likewise, for a buy signal, the relative strength index entered the oversold region here, triggering a buy between these 2 points. The same was said for this case, and for this case. But now the problem is, it doesn't help if you have a band of sell zone. You need to find the most optimal point or an optimal point to sell, and this range doesn't help. This is where the moving average comes in. Okay, so now you'll see that I've taken the relative strength and I've applied the moving average to it. Like with the stochastic, you'll see that I've applied a 14-day RSI with a 7-day moving average. Now, the points that we looked at earlier using the moving averages look like this. At this point, the relative strength index was in the sell zone, and like the stochastic, when the relative strength crosses below the moving average, this triggers the sell, and as you can see, this was a good selling point. Back to this point from earlier. Earlier, the sell point was within this range. Now, with the moving average crossover, the buy-in point would have been here. But as you can see, this is not an optimal buying point, as this was not near the bottom. This is because the way that this relative strength index is set up, there's still a lot of volatility in the relative strength index. And as you can see, this was a false buy signal, but the real buy signal was over here. Okay, so one way to remove some of this volatility from the relative strength index is to increase the period and increase the moving average. So go to your RSI and change your RSI period to 21 and apply a 9-day exponential moving average. If you see now, this application would have eliminated this false buy, as the point at which the relative strength index broke above the moving average was over here. So let's move the buy position to over here. And as you can see, that would have been a much better buy signal. Same as with before. So let's quickly run through it. So there was your sell signal. At this point, you would have been given a buy signal. Ridden it up till this point here, which would have triggered the sell as the RSI moved below the moving average. At this point, the buy would have been triggered, and the buy would have been held until this point, where the sell would have been triggered as the RSI crossed the moving average. This method doesn't always work absolute though. As you can see, the method sort of cancelled itself out a couple of days later as the buy signal was triggered again. Thus, it's always good to combine indicators and formations to give a more clear picture. Okay, so now we're going to be discussing the next part of the relative strength index, and that's divergence and confirmation. Now, I'm pretty sure if you've watched any technical analysis TV show, you will have heard at some point someone talking about divergence or sell divergence or the RSI confirming the trend. Now, these concepts are very simple to understand. The first one that we'll be discussing is the sell divergence. The sell divergence occurs when the share price makes a new high, but the relative strength refuses to confirm, as the relative strength does not make a new high but makes a new low. Now, a sell divergence is usually an indication that the share price has reached a topping point and will see some retracement to come. Okay, so now for an example on the sell divergence. Okay, so as you can see, this is the share price for a certain share, and you can see that the share price was continually making new highs, and the RSI was confirming, but we'll get into that in the next video. But here is where the sell divergence occurred. So you can see that the share price made a new high there and continued and made a new high over here. But as you can see on the relative strength index, the relative strength index went from a high to a lower high. So this was a sell divergence case where the RSI was refusing to confirm the new share price high. And as you can see, after this point, the share price saw a significant pullback, confirming the sell divergence. Okay, so a sell divergence is not only limited to share price and RSI tops. A sell divergence can also be applied to the RSI bottoms and share price bottoms, as you see in the example over here, where the share price made higher lows while the RSI did not confirm this and the RSI was making lower lows. So let's get onto an example of this. Okay, so now an example of a sell divergence but on the RSI bottoms, not the RSI tops. Okay, so as you can see an example in front of you, you'll see that the share price keeps making new higher lows, while the RSI does not confirm this and keeps making new lower lows. So this would be an indication to an investor that potentially a new bottom would be approaching. So after this point, there was a lower high on the share price and the share price made a new low. So this is a good example of when a sell divergence worked out. Okay, so the next divergence that we're going to be discussing is the buy divergence. Now how a buy divergence works is when the share price makes a high and then moves down to make a lower high, but the RSI does not confirm this and creates a new high. Okay, so let's get an example of this. Okay, so on screen you'll see the example of the buy divergence. You'll see that the share price made a high, came and made a lower high, while the RSI made a new high value. And after the pullback, the share price made a new high, and this would have been an indication that the share price was going to make a new high. And combining this with stochastics and moving averages, like we discussed in previous videos, you could have profited off this this large upward movement. Okay, so like the sell divergence, the buy divergence can also be applied to the RSI bottoms, like in this example on screen, where the share price was making new lows, while the RSI bottoms were not and refusing to confirm and making new higher lows. Now, let's get onto an example of this. Okay, so the example that we're going to be using is the same example that we used for the tops explanation. Okay, so just to recap, here it was, the RSI tops were increasing while the share price was decreasing, so there's a buy divergence indicating that a new high would probably be formed. But then this low came, and as you can see, the share price made an RSI low here, carried on its downward movement until this point where the RSI was increasing as time went on. So this is a very good example of buy divergence on the RSI bottoms. And at this peak, the share price broke out and extended out for a massive rally. And this is actually called a falling wedge formation, but we'll discuss that in the next couple of videos. So this is the example of the buy divergence, but on the RSI bottoms, and how using them in a pair would be a very good trade. Okay guys, just because this tutorial has been quite long, I'm going to be splitting it up into two parts, so don't worry, I will be finishing the tutorial on the relative strength index. As always, if you want to follow me, it's at TechTraderJSE, and the Google Play mobile application is called Trading Technicals on the Google Play Store. And guys, if you liked the video, please give it a thumbs up. If you have anything you want me to cover, or something that's a little bit confusing still after the second video comes out, please comment, and if you like the channel, please subscribe. Thanks.